Welcome back to another amazing episode of the St. Louis podcast. As always, my name is Eric Brown. I'm host here, CEO at Vi Media, which is, of course, a digital marketing company, partner at a holding agency. But more importantly, we have news today. And we have a lot of news today. Some interesting, some funny stuff from St. Louis. So let's just get right into it. Now, you guys think, hey, Eric, you're going to talk about MoDOT, right? Fire him. I think we've all talked enough about MoDOT this week. Someone needs to get fired. Multiple people need to. Sorry, we weren't prepared. We thought it was going to come in later than it did. And apparently, MoDOT is not fiscally responsible. Like, they're not dependent on like the legislator or anything like that. They're their own separate entity when it comes to spending the money how they want to spend it. Now, I did read an issue, something where it said MoDOT has like the 5th longest road system to clean, and they are given like the 40th amount of money by states. So maybe MoDOT does need more money. I don't know 100%. But we do know that, of course, this has been an issue for ongoing years now, that MoDOT does not have enough drivers. And if you go and read why they don't have enough drivers, it's simply because you have to have a CDL, right? And the people that have CDLs have normal jobs where they get paid more likely more than what MoDOT would be offering. So why would anyone want to go clean roads for MoDOT? Now, on to the next subject, because we're all pissed at MoDOT. Blah, blah, blah. National Weather Service said they're sorry. It moved in a couple hours earlier. A couple of hours shouldn't make a difference of people getting standstilled for 4 to 5 hours on a highway after 3 inches of snow. Now, I will also blame all of you St. Louis drivers that suck absolute ass in driving in snow. Okay? You can't drive the normal speed limit. And also, all you people that have bald tires, you're not going anywhere in the snow. But what am I going to do? People have jobs. They have to get places. Like, I saw so many people on social media like, why are you out on the roads? It was a Monday. People have jobs. In case you didn't pay attention, everything's expensive. Everyone's broke. They can't take a day off work. God, people on social media are dumb as hell. They just get dumber. The takes get more and more dumb. Like the IQ of US as you intake information from social media, your ignorance goes up and your intelligence goes down. Ugh. All right, anyways. On to something which I found honestly even more funny than this whole MoDOT situation. And when I say funny, I just mean funny in terms of mismanagement. Like, it's hilarious that we do everything we need to do, which is tax dollars. We pay our bills, right? They get the money. We should get the service, okay? In St. Louis, we're already putting it up with enough bullshit of construction on major highways that the least they could do is try and, when it snows a little bit, treat the shit so we don't have this problem of literally every single interstate essentially being at a standstill for hours. It's crazy. All right. Moving on. Now we have another $1 million plus mistake for St. Louis taxpayers. You ready for this? A mistake in the region's new MetroLink train order. So in case you guys didn't know, a couple of years ago, we ordered trains, of course, new trains, because a lot of our trains are old as hell. And if you've ridden the Metro, you know that. Officials placed an order over 2 years ago for brand new trains for the region's MetroLink, but now there's a problem. The trains that they ordered already need to be fixed before they can safely operate in the system's tunnels. Now, why is that the case? I read. I was thinking, why is that the case? Why do they need to be fixed if they're brand new trains? Well, let's talk about it. So metros are often above ground. Of course, for ours, we also have tunnels that take riders under the ground, right? They're not new. Some are more than 150 years old. That's why experts said Metro officials should know how to measure them. So essentially what we did was we ordered trains that can't fit appropriately inside some of these tunnels. And I think that they fit, but we'll talk about it here. There's not enough clearance, and that is regulated. So back in 2023, the then Secretary of Transportation, Pete Buttigieg, rode the Metrolink with local officials announcing a major investment in the light rail system. 55 new trains with a price tag of more than $390 million. Many of the vehicles are currently as old as the system itself. So, in November 2023, the Bi-State Development Board, which runs Metro, created specs and selected a company, Siemens Mobility, Inc., to begin building. All of you guys are morons, whoever's responsible for this. Fast forward to now. In order to safely operate Metro in all of the system's tunnels, the trains, of course, have to be smaller than the tunnels themselves, duh. But you also have to have a buffer in the clearance, which is a safety mechanism. So with the high voltage wires, there's no dangerous arcing or buildup of static electricity, which I'm sure we've learned this from situations in the past. We have Carl Berkowitz. He's a transportation expert with 50 years of experience, saying this is engineering 101. This is like basic stuff. So this is a measuring mistake. He goes on to say it's basic engineering. I don't know how it can happen. I can't understand how it could happen. In your experience, a change order for something like this, is that common? Berkowitz says, no, this is an engineering error. This is going to cost over $1.4 million to fix. So I saw this and I was like, this is classic. This is just classic. What are we doing? So the Bi-State, who's in charge of this again? What did I just say? The Bi-State Development Board. Maybe there's too many board members and not enough people to actually know what the hell they're doing. Let's look at who's on the board of the Bi-State Development Board. Oh, of course it's... We got Secretary, Vice Chair, Chair, Treasurer, Herbert Simmons. Herbert Simmons, you're the treasurer. Who's the engineer? Who would have been in charge of the engineer? Jesus Christ, half of these people are 70 years old. Bi-State, what are you developing? You're going to be dead in 10 years. Why do you care? All right, anyways, that's the news story of St. Louis. Just continuing on with the trends of what the hell is going on. I do want to talk about next week the St. Louis County issue that we have with apparently we are $6 million underfunded this year. Think, if not more. So we'll talk about that next week because I was curious on that. And there are actually a few good points of saying it's not necessarily corruption and greed. It's simply the case of we have so much infrastructure in the county because the county's so massive that it takes a lot to uphold that infrastructure. And we simply don't take enough from taxes to pay for it. So we'll talk about that next week. Now, what I've been saying on this podcast for a few weeks now is I wanted to get into the 50-year mortgage because if you go online, and I'm sure this is old news as of now, no one cares. Now we're talking about Matt, did you see the news about Trump, going to give every child like $250? That way when they turn 18, they'll have $1,600. Now, just unbelievable grifting. They think we're stupid. Here's $1,000. Will you guys all shut up now? Yep. It's supposed to be 2,000. Yep. Like $250 a kid, yeah. And then Michael Dell was on there saying, I'll make a contribution. Of course, Michael Dell was involved in the TikTok thing, so I'm sure he made a bunch of money. But anyways, okay, 50-year mortgage. let's talk about this because I've seen online, of course, everyone in the real estate field is excited. They're like, "Ooh, more people can buy now, and it's going to be good." No, it's not good. It's not good for affordability. It's not good for the borrowers. It's only good for the real estate agents, the people selling loans, of course, the investment companies, the banks, everyone profiting from this. But the person that is getting the loan is getting screwed. So let's talk about it. Everyone's like, well, it's, don't get it if you don't like it. This will affect everyone. Simple. As simple as that. So, of course, 50-year mortgage, that's what it is. It's a 50-year mortgage instead of the traditional 30-year, which we think of as a traditional mortgage. And, of course, obviously the 15-year mortgage as well. Now, what we've been told, this is going to help affordability, right? It's going to make it more affordable because your monthly payment is going to go down a little bit. The monthly payment does not go down that much in comparison to the long-term detrimental effects. Like, let me put it to you this way. If the couple $100 that is a make or break between a 50 and a 30-year mortgage, you probably can't afford a home. Save some more. Okay? Save some more. It sucks. Save some more money. Because the last thing you want to do is sign up for this 50-year, and I'll get into it. Okay. So, we have... You can just look up online and look at stats, look at anything, look at Japan's 50-year mortgage, which I'll get into, and what that cost. So across the field, right, there are multiple downsides that are financial experts, economists, real estate sources, and the downsides significantly outweigh the benefits for most borrowers, both in the short term and over the long term, right? So let's kind of break it down. Let's talk about the immediate impacts now, what it could lead to in the future, and also who's benefiting from this. And we'll talk about Japan a little bit as well. So, all right, of course, higher total interest costs from day one, right? If you have a 50-year mortgage, more likely than not, you're going to be paying a higher interest rate than a 30, and then, of course, than a 15. So you're already paying a higher interest rate out of the box. The extended term means you're paying interest for 20 extra years compared to, of course, a 30-year loan. Even with similar rates, this balloons the lifetime interest paid. For instance, on a $400,000 loan at 6.5%, a 30-year mortgage might cost about $2,500 a month, while a 50-year mortgage might cost $2,250, right? So we're talking about a difference of $250, $270 a month. But the total interest in that loan would nearly double. So analysts estimate that for a median priced home, a 50-year loan could double the amount of interest paid over the loan's life compared to 30 years. This isn't just theoretical. It's because amortization schedules front load interest, right? So if you have a home, you're probably aware of this, or if you're not, maybe you should have paid attention. But amortization is essentially the scale at where you're paying off your loan and what's going to the actual interest versus the principal of that loan, right? And even with the 30-year loan, we know that it's heavily front loaded, that you're going to be paying a lot of interest versus the principal. Okay. So with that said, so in the first decades, payments skew even more heavily towards interest than in a 30-year loan. Only about 6% of the payments go to principals in these years versus 23% for a 30-year. So on a $500,000 loan at 6%, you're looking at over $700,000 in total interest versus $420,000 for a 30-year mortgage, essentially paying the house price twice over just in interest. Let me say that again. On a $500,000 loan at 6%, you're looking at over $700,000 in total interest on a 50-year mortgage versus $420,000 on a 30-year mortgage, essentially paying the house price twice over just in interest. So, higher interest rates and premiums for duration risk. Lenders would likely have to charge a premium for the added risk of long-term holds, right? Estimates range that we'd be looking at anywhere from a 0.3 to a 0.5% higher percentage than a 30-year rate. Using current averages, a 30-year at 6.3 might run $2,295 monthly, while a 50-year at 6.83% drops to $2,176, a savings of just $119 per month. But the total payout jumps from $734,000 on that loan versus over $1 million on the 50-year loan, with interest alone rising from $402,000 to $750,000. For a $400,000 loan at 6%, this erodes the monthly savings down to just $166 a month, while inflating total costs to $863,000 in interest alone. Double the $418,000 on a shorter term. It's marketed as affordable, but the math shows it's a lender's, it shows on here a lender's dream, but I will say a lender's wet dream. Because that is just cash, baby. Cold, hard, interest cash. Gotta love it. Of course, we could see why the banks want it. The powers that be want it. They don't want us to be rich. They want us to be slaves to the system and paying for 50 years on a mortgage, which means right now that with the average home buyer's age, more than half of those loans would not be paid off by the time a person dies. It's crazy to think about that. All right. Do we get the point about interest, right? That you're going to save a couple $100 a month in order to pay hundreds of thousands of dollars more in interest. And of course, it could be way more depending on your home value. Not only that, one of the biggest reasons you buy a home, of course, is you want to build equity. Well, if you're pretty much paying almost entirely interest, obviously you're not building much equity, right? So in the early years, payments go mostly towards interest rather than the principal, building home equity at a crawl. For a 50-year loan, you might not see meaningful equity growth until well after 10 years in. I'll say that again. For a 50-year loan, you might not see meaningful equity growth until well after 10 years in. This leaves you vulnerable. If home prices dips or if you need to sell quickly, you could end up underwater on the loan or with little profit. Or no profit, obviously, underwater. If home values dip, you're stuck owing more than the house is worth for longer with little principal paid down. This is not hypothetical. Posts from recent buyers highlight how you'd likely be underwater if selling within 5 to 10 years, assuming flat or declining prices. Now, of course, we always think line go up. Line go up, right? As far as home prices are concerned. And I talked about on this podcast about how, the Fed is going to start quantitative easing next year and printing money, meaning inflation is going to go up, meaning the stock market and home prices should go up as well. But at some point, when are we going to hit the inflection period of home prices continue? Affordability is simply not there. And we had a, episode, I believe a month ago about diving into some of that stuff about how, 70% of the people or 80% of the people have interest rates on their, mortgages under 5%. Makes it very hard for them to move, right? Because you're now going to move into, let's just say, a little bit smaller house, and maybe the house is even cheaper than your house is now, but your interest rate's 3.5%. You're now going to be paying more on a smaller house. So we have to see people die. We have to see people move. We have to see people get fired and essentially lose their job in order for something to happen. But of course, we have the whole other side of investors, hedge funds, and all these people that own all of these homes as well. And I saw earlier that, and I didn't read into it, that Zillow is sounding the red flag. All right. So I think we get that. All right, qualification of cash flow risks, right? Where while lower payments might help more people qualify, it could attract marginal borrowers who stretch their budgets thin. That's exactly what I was just saying. If you're basing your affordability off a couple $100 a month, you cannot afford a home because stuff can go wrong. You're going to have to fix stuff. If you can't afford a couple $100, do you have an emergency fund? Do you have money set aside to pay for things? It makes it a lot harder, and myself included. I've talked about this a billion times. I need to make a decision on what I'm going to do in the middle of February. Home prices are high, interest rates are high. Sure, the question is, I guess I can afford it, but I'm stretching myself. And God forbid something goes wrong with, my businesses, right? Because, of course, they're attacking small businesses on a daily basis. All of a sudden I could be out. And I'd be in a situation like this where maybe I only have the home for a couple years. I haven't built up much equity. I put money into the house, and now I'm, maybe the price didn't even go up, and now I'm out. And, of course, then you have to pay 6% to sell. Well, there goes all your money. All right. So if rates rise or personal finances change, the long commitment becomes a burden. Some proposed versions start with interest-only payments, delaying any equity growth and turning the loan into what feels like perpetual renting from the bank. Perpetual renting from the bank. I'll say it again. Plus, it doesn't address underlying issues like high home prices or limited supply, which we say limited supply here. And I've actually watched videos of people, that write extensively about this and say it's not really a supply issue. It's the fact that we have all of these, Airbnbs and things like that. We have, we have all of these investment properties, these short-term rentals. All of this stuff is contributing to, obviously what we deem a limited supply, right? And we're going to continue to see these, get sold. I think the heyday of short-term rentals is over. By qualifying more buyers with lower payments, these loans could flood the market with demand, bidding up prices further and worsening the affordability crisis they aim to solve. What did I say beforehand? More people are going to be able to buy. And that's not necessarily a good thing again, right? This is what I'm saying. Economists compare it to historic bubbles. Home price to income ratios are already at 5-1. A healthy is 3-1. And this could detach them even more, especially with institutional investors snapping up properties. Make it illegal. Make it illegal. Why is everything a gamble? Everything has to be an investment. Everything has to be for the shareholders. This is the United States of gambling. I'm sure a lot of people in St. Louis saw that some of your all favorite website, Prawn Hub, is no longer available. You have to put your ID in. And I saw a lot of people talking about that. And then, of course, at the same time, we now have legal gambling in the state. Very odd. It's an odd thing. And you saw CNN partnered with Kalshi. Matt, did you see that? insane. If you guys don't know what Kalshi is, it's just Polymarket. You guys can essentially bet on politics and news and things like that. They've officially partnered with CNN, which means that CNN was fake news this whole damn time. Because Kalshi, somehow a gambling site, made them more reputable. Insane. We're ass backwards, folks. United States of gambling. Is Trump going to say, shut your mouth, piggy, again in the next 30 days? What's the percentage on that? Anyways, off topic, ADD. All right, so broader market instability. Introducing these loans could create ripple effects like increased delinquencies and economic conditions worsen. If economic conditions worsen, which we see them, not getting any better, similar to trends seen with extended auto or student loans. Economists warn it might fuel a housing bubble, as seen in Japan's 1980s experience with even longer mortgages up to 100 years. So we'll talk about Japan here in a second, where easy credit drove up prices before a crash. Okay. So like I was saying before, I'll just cover this one more time. This is an illustration of a $425,000 home, which is the median U.S. price as of late 2025, with a 20% down payment, so a loan amount of $340,000. The 30 years at a 6.22%. Monthly payment with insurance, $2,038. Total paid over the lifetime of the loan, $734,000. Total interest paid, $402,000. Now, we've already talked about how at 6.22%, the amortization schedule is insane compared to even a 4 or 5%, right? But now let's compare this to a 50-year mortgage at 6.83%. Your payment only goes down to $1,802. So it's about $200 less a month. Your total interest paid over the lifetime of that loan is $81,000. So $1,081,000. The total, and again, I'll go back to the 30-year. 30-year was $734,000. The total interest paid, $402,000. 50-year, $750,000. Now, is the $200 a month savings worth paying an extra $350,000? And worth not getting any equity potentially over the first 10 years of that loan? And probably you not being able to pay off that loan before you die. And the fact that you're going to have to sit in your house when you're 80 years old, wanting to retire, still making that damn mortgage payment, right? All right. So what are the downsides? Obviously, like I just said, debt lingering into old age and elevated retirement age. The median first-time home buyer is now 40 years old. I've read 42. So a 50-year loan means payments until age 90. What's the percentage of the U.S. population that makes it to 90? This is going to be a depressing stat. 5%. 1 in 20. Damn. That's sad, bro. That's, ugh. I kind of want to live to like 90. But it seems like, hey, maybe I can go on a call sheet and put a little bet on when I die or not. All right, this overlaps with reduced income in retirement when you might rely on Social Security or savings. If life expectancy continues rising, average now is like 78 to 80 years old, many won't outlive the loan, potentially passing debt to their kids or whoever, next of kin, whoever takes whatever it is. A shift from traditional mortgages designed to be paid off during their working years. With first-time homebuyers averaging 40, payments stretch to 90, effectively pushing the debt-free retirement age to 70 or beyond. Critics call it financial enslavement or worse than sharecropping, as you're locked into payments during fixed income years, limiting flexibility for healthcare, travel, or inheritance. Massive opportunity calls for wealth building. With equity building so slowly, you miss out on using your home value for future needs like downsizing, funding education, or emergencies. Over 50 years, the steep cost of extra interest, like I just said before, over $300,000 in extra interest over that 30-year period, erodes your net worth. It could destroy wealth by limiting investments elsewhere, as funds tied into interest can't grow in stocks or retirement accounts. One analysis warns it destroys wealth building compounding, as funds funneled to interest can't invest elsewhere, obviously. Vulnerability to economic shifts and tactical risks. Future rate volatility, inflation, or recessions amplified risks. A fixed rate 50-year loan protects against rate hikes but costs more upfront. If rates fall, refinancing might not save much due to the long horizon. Job loss or health issues could lead to default, especially with minimal equity as a buffer. In volatile markets, this might resemble renting from the bank long term, which we've heard, with tax benefits, but little ownership upside. Some suggest using it short term, low payments now, refinance later. But this bets on favorable conditions. This is like the thing I hear all the time. Well, do it now when the rates go down. You'll be able to refinance. Who says the rates are going to go down and when? The only people telling you that are mortgage loan officers and real estate agents. Sorry. I love y'all. Some of y'all. I get it. Their big thing is you're just paying if you're renting, you're just paying your landlord's mortgage. Some people don't want to have to fix their own shit, Some people don't have the money for a home, obviously, as I think we've talked about on this podcast time and time again. Obviously, we have taxpayer risk. These loans could create financial instability by inflating home prices now, making future affordability worse for the next generation. Japan's long mortgage era hints of stagnation, oversupply in some areas, demographic aging, and low growth magnified downsides, leading to bubbles and crashes. It makes symptoms, which are high prices, without fixing supply constraints, zoning issues, or wage stagnation. If these become government-backed, like the FHA loans, defaults could lead to massive losses. Higher loan-to-value ratios mean bigger hits when equity is low. Also, psychology. Being in debt for half a century might suck. Half a century. That's what it should say on the loan document. Yeah, well, their experience with long-term mortgages, they did this in the 80s, 50 and even 100-year multi-generational loans. Okay, if my parents sign me up for a multi-generational loan, I'm gonna have a problem. Unless they paid that shit and pass me. Unless we got some equity, right? All right. Anyways, yeah. All right. Japan was in the midst of an asset price bubble fueled by loose monetary policy, rapid economic growth, and easy credit from banks. To make soaring property prices more affordable. So again, they had, their prices continued to go up. They wanted to make prices more affordable. They had lenders introduce extended mortgage terms, often 50 years or longer, with some designed to span multiple generations. These were sometimes marketed as estate planning tools to minimize inheritance taxes, appealing to affluent families, but they became widespread amid the frenzy. So, of course, what happened was a classic bubble buildup. Speculative buying drove real estate prices to astronomical levels. Tokyo land values rivaled those of entire U.S. states at their peak. Easy access to long-term debt amplified this, as borrowers could stretch payments thin, qualifying for larger loans, right? Paper thin, couple $100 a month between a 30 and 50-year mortgage. Again, for further inflating demand without addressing underlying supply constraints, right? So what they did was they essentially tried to put a Band-Aid on a bleeding wound, and it just bled right through, right? Because you didn't fix the underlying problem. However, by 1990, the Bank of Japan raised interest rates to curb inflation, popping the bubble. Stock and real estate prices plummeted. Residential land values dropped by up to 80% in major cities over the next 2 decades, from 1991 to 2006. This triggered the lost decade, though some argue it is extended for a longer period of time, marked by economic stagnation, banking crises from non-performing loans, and persistent deflation as consumers cut spending amid falling asset values. So the consequences for Japan, are still ongoing. Households found themselves underwater on massive debts that outlived their working years. What did we just talk about? The 50-year mortgage. With real estate returns and rising mortgage costs eventually outpacing rental incomes, making payments unsustainable for many. This led to widespread foreclosures, reducing household wealth and generational burden, families inheriting not just properties, but crushing loans, right? So again, next person has to take it over, stifling mobility and investment. Broader effects included sharp drops in consumption, corporate bankruptcies, and deflationary spiral that Japan struggled to escape for years, even with aggressive stimulus. It exacerbated issues in an aging society where retirees faced ongoing payments without income growth. Experts cite this as a warning that long-term mortgages can mask affordability programs, fuel bubbles, and create systemic instability without solving root causes. So, first time in young home buyers, right? 20s and 30s stretched to enter high cost markets. And then, of course, it crashed. You have lower income or marginal borrowers, and then investors or tactical users. All right, who wants this? Obviously, you have a benefit for real estate agents. More people available to buy. Again, the home prices will go up. They get paid on percentage. They make more money. Faster moving inventory means they're going to be able to sell more as well. Sell more homes, right? List more, sell more. So not only is the price going to go up, they're going to be able to sell more. Obviously, it's good for investment companies. It's good for banks. It's good for lenders. It's good for absolutely everybody, company-wise. And, of course, those people in the profession, except for all of us that own homes or want to own a home. Now, it will probably continue to help the people right now that have already seen their wealth drastically increase over the last, call it 5 years, with home prices and how much they've skyrocketed. And realistically, those aren't even the people that need the help right now, right? So, I'm not going to draw conclusions on why people think this is a good idea in government. But I could say that I would assume, the banks and, investment companies and lenders, they're probably tossing them some cash, right? Because this system is corrupt. They don't care about us. But I thought you guys would, I've been kind of researching into this and thought you guys would get a kick out of that. Really understand. Send people this video. If they're like 50-year mortgage, who cares? Send them this. Pick out the exact part where I was going through specifically how much more people are going to be paying in interest, and that the amortization, you're not going to build equity for the first 10 years. And that the majority of people are going to die before their home's paid off. And the majority of people are going to still be paying the mortgages when they're supposed to be retired on fixed income, et cetera. So this is not good. This is not fixing the root cause. But when have the politicians ever fixed the root cause? All right, that's all the time we have for today. As always, thank you for tuning in. Please like, review, subscribe, leave a comment. We appreciate everyone's support, of course, as always. It's that season. It's cold out. West County Insulation here in St. Louis getting a ton of calls. If you want a free estimate, a free quote, a free proposal, West County Insulation will come out to your house. If your house is cold in certain areas, you're running the heater too often, right? One room's colder than the other. Or just poke your head up in the attic. See if you got, over a foot of insulation. Take a ruler up there and make sure you got a foot of insulation everywhere. If you don't, you probably need some. Hit up the boys, West County Insulation. They'll get you taken care of. Of course, as always, talk to the marketing company, Vi Media, best damn marketing company on the planet. And last but not least, you're looking to record a podcast. You need help with distribution, editing, posting, etc. Reach out to the boys here at Half Coast Studios. And that's all we have for today. Thank you. Bye-bye.